Deep Dive, Sable Offshore. Part 9. Why it can still work. Sable's only interesting if a handful of specific catalysts hit in time. If none of them do, we're looking at a slow burn to zero, like Veneco back in 2017 when the same pipeline issues stranded their platform. So the thesis boils down to needing at least one of these four things to break right, and soon. First up, the pipeline restart and getting to actual sales. This is the cleanest path. They restarted production May 15, 2025, about 6,000 barrels a day from 6 wells on Harmony platform. That's real oil after a decade shut-in, but none of it's sold yet. It's just filling those 540,000 barrels of storage at Las Flores Canyon, waiting for the onshore pipeline to get the green light. Late 2025, PHMSA stepped in hard, reclassified the lines as interstate, issued an emergency startup permit citing the presidential energy order. That bypassed a lot of California's holdups. If that federal approval survives the ongoing legal fights from enviro groups and state officials, Sable could start transporting and selling pretty quickly. Early tests look good too. The wells are coming back stronger than 2015 levels, when the field was doing around 45,000 BO a day. Bottom line, if regulators and courts let them move oil in the near term, cash starts flowing, the liquidity crunch eases, and refinancing the debt gets way easier. Second, Exxon extends or amends the loan. Exxon financed most of the acquisition, about $623 million of the $643 million purchase price, with a seller note that's now closer to $900 million with interest. It's secured by the asset, so Exxon basically holds the keys. The November 2025 amendment bought time maturity out to March 31, 2027, or 90 days after first sales, whichever hits first. But Exxon could still be the lifeline if they give another extension or restructure on reasonable terms. They don't want these fields back. They spent years trying to exit California. If they see pipeline progress or federal momentum, they might prefer keeping the loan alive, getting repaid cleanly, and avoiding the mess of repossessing or dealing with decommissioning. One more amendment could kill the immediate default risk and give Sable real breathing room. The financial landscape of the Santa Ynez unit acquisition reveals a massive disparity between the billions historically sunk by ExxonMobil and the relatively small cash position of Sable Offshore. Over decades, Exxon spent upwards of $2.5 billion to develop the Heritage, Harmony, and Hondo platforms, followed by approximately $720 million just to maintain them in an idle state after the 2015 spill. In contrast, Sable acquired these assets for $643 million, but only put up about $20 million in actual cash at closing, with the remaining 97% financed by a loan from Exxon. While Sable has since spent roughly $200 million on facility refurbishment and preparing the offshore storage and treatment (OS&T) workaround, their total risk exposure of $250 million is eclipsed by Exxon's $3.5 billion total stake. This OS&T strategy is critical because it bypasses hostile California state regulators by moving operations to federal waters, where jurisdiction shifts to federal agencies like BOEM, BCE, and the U.S. Division Ship Reforms. Coast Guard. Third, the offshore/tanker route gets permitted and funded. Plan B, bypass California completely with an offshore storage and treating vessel and shuttle tankers. Sable announced it formally in September 2025 as a parallel path. The idea isn't new. Santa Ynez used a similar floating system from 1981 to 1994, before the onshore facilities were ready. Everything happens in federal waters, federal regulators only. No coastal commission, no county veto. Oil processed, stored offshore, loaded onto tankers, shipped out potentially to refineries outside California. But it's capital heavy and slow. Reports say roughly $450 million for the vessel/acquisition or conversion, plus $300 million in ops costs, on top of refinancing Exxon total funding needs pushing $1.7 billion. Timeline slips first sales to late 2026 if they go this way. Sable's looking for federal support loan guarantees, infrastructure funding to make it work. The positive case is they get federal permits, looking friendly right now, line up financing without killer dilution, and unlock the field even if the pipeline stays blocked. Fourth, Flores executes. You're betting on the jockey. Jim Flores has done this before, built Plains exploration and production from nothing, sold it to Freeport-McMoRan at the cycle peak. He knows California heavy crude, he ran Freeport's oil and gas after. And he's got real skin. Roughly 8% ownership, about 11.2 million shares. His son also has ownership in the business. That's alignment. He's not sitting back. If he can navigate the regulatory maze, arrange capital, keep Exxon reasonable, and get oil-flowing pipeline or tanker, this could be his next big one. His track record and stake give you some confidence he'll fight every angle. If none of these happen, if none of these catalysts materialize, the outcome is straightforward and ugly. Sable can keep producing oil into storage for a while, but without a legal path to sell it, that oil has no economic value. Cash continues to burn, the 15% interest on the Exxon loan compounds, and the minimum cash covenant becomes harder to meet each month. Eventually, the company runs out of runway. At that point, Sable doesn't fail because the reservoir is bad or the asset is broken. It fails because it can't access a market. That is exactly what happened to Veneco. Viable production stranded by regulation, no bridge to sales, and no way to service debt. If this scenario plays out, equity holders are wiped out, the oil remains in the ground, and responsibility for decommissioning ultimately shifts back to Exxon or the state. So why would value investors own it? Li Lu from Himalaya Capital reportedly took about a 1.25% stake, small position, but meaningful for him. This is event-driven optionality, not a compounder you hold forever. The market is pricing in almost zero chance of a near-term restart or offshore solution. That's why the stock trades at a huge discount to any reasonable reserve value. If even one catalyst has better than EV odds, it's mispriced. Li Lu likely sees it as classic asymmetric payoff, small bet for big reward. Upside if oil sells and liquidity crisis lifts the stock re-rates hard, from zero revenue to strong cash flow at tens of thousands of barrels a day. Downside is capped by position size. It's Kelly-style thinking, high upside, limited downside via sizing. They aren't in love with the business today, they're buying the cheap call on the unlock event. If it materializes, the current price looks absurdly cheap in hindsight. What really matters from here? A few questions cut through everything. Can Sable legally sell oil soon? Producing without selling is a ticking clock. Oil in tanks doesn't pay bills, it just adds obligations. As of early 2026, that legal path is still in limbo. Federal authorization in December 2025 was a big win, but it's temporary and under heavy challenge. Court hearings on the pipeline continue. Without actual sales, soon finances deteriorate fast. Can they raise enough bridge money? And how much dilution? Liquidity won't last forever. They need capital to survive to sales. CEO Flores admitted on a leaked call they'd likely need up to $200 million in equity by end 2025 dilutive lifeline. They're also talking debt, government guarantees, how much cash, on what terms. If pipeline looks imminent, raising gets easier and cheaper. If not, it's distressed equity. Timing is everything. If they run out before a solution, equity's wiped. Will Exxon extend or amend? Exxon is the banker right now. Loan terms and deadlines are make or break. Not public if talks are happening, but it's the focal point. Exxon doesn't want the assets back, but they aren't a charity. Hope is they see progress and give runway. Watch 8Ks on the loan. It's pivotal. Is the tanker/offshore plan financeable on a survivable timeline? If pipeline dead ends, this is the only way. Needs big money, $750 million in new investment, and won't be quick, first sales late 2026. Can they get attractive financing? Government support? Low-cost debt? Or is it high-yield/equity that kills shareholders? Monitor financing news partners, government loans, term sheets. Feasibility is financial, not just technical. What matters less than people think? Twitter/X, noise, and celebrity commentary. Phil Mickelson rallying on X, partisan takes, Trump EO mentions, fun headlines, sentiment bumps, but they don't get oil flowing. Regulatory and capital due. California Coastal Commission drama fines, cease and desists, delays, scary press. Real, but they can't unilaterally block forever. Federal jurisdiction trumps a lot of it. Big PV, 10 or $10 billion asset value debates. Reserves are world-class, but value only matters if monetized. Market prices as if oil is worthless until sales start. Focus on go/no-go factors, not theoretical NAV. The photo of the corroded Line 901 repair after the 2015 spill says it all. That onshore pipeline was the critical path. Federal regulators claimed jurisdiction late 2025 and issued a temporary permit bypassing California opposition. Success hinges on that pipeline working, or the offshore alternative stepping up. That's the story. This is Avi. Like and subscribe. On to the next.